As part of CNBC TV 18's 20th anniversary celebrations, we've been bringing you a unique insight into what makes the top fund managers tick, what goes into their decision-making process, and what differentiates them from their peers. In this whole ecosystem, the philosophy of the house, the AMC, is also important to understand how fund houses formulate their investment thesis and what is the view from the top. I invite Aashish Somaiyaa, MD and CEO of Motilal Oswal AMC. Hi Aashish, thanks very much for joining in. And I must say that the AMC, while it may be small, it has a very loyal following. So when you have when you name your funds, like for example, I noticed that you have the Focus 25, the Mid Cap 30, Multi Cap 35. Why does it always have a defined universe? This is not something we've seen in other fund houses. So what made you take this decision to define your universe of what's the maximum number of stocks you can have? I mean, is it more just positioning or does it really help?
So it's actually a thought process. We believe that portfolios should be focused. I mean, on the one hand, you have highly diversified portfolios like 50, 60, 70 stocks. And then if you say concentration, I would say that would be more like 10, 12 stocks. So we believe that portfolio managers should kind of demonstrate conviction. They should stick their neck out and they should have belief in what they're owning. So there's a serious thought about restricting the number of scripts that a portfolio manager can own in any portfolio. So the numbers you're referring to are hard-coded. We can't have more than that many number of stocks in the portfolio. So that comes from a belief that portfolio should be focused. And, but on an average, we still have in the range of 20 to 25 stocks in every portfolio.
You never really reach the cap anyway.
Yeah, never reached the cap.
Okay, even this multi-cap 35, that's been a fund that's earned you quite a fair amount of grief, actually, say over the last 1.5 years, but it's back to giving now 15% returns. Do you think you've redeemed yourself with this recent performance?
No, look.
What would you say to investors who were unhappy?
Yeah, I mean 2018 was a difficult year, and how I would put it is that markets rotate in and out of favor of investing styles and certain stocks at different points in time. For example, the most quoted book in the investing world is Intelligent Investor, written by Benjamin Graham, and chapter 9 of that book actually has a chapter on mutual funds. And all the new editions have commentaries from Jason Zweig, who's very widely respected. I'll quote you an example from there. It says that there was this one particular fund which had a tenure of 29 years, and 12 out of those 29 years the fund underperformed the benchmark. So there were 12 occasions when somebody could have kicked it out. But in 29 years what happened? It gave 4 times the return of the index. So that's why I said that there are phases in the market where certain investing styles, certain stocks and sectors, they go out of favor. Now, like you said, we bounced back. But what is most interesting is that we bounced back despite not churning the portfolio. There's barely an annualized churn is hardly 15% or so. So what it means is that we stuck it out. So where rectifications had to be made, we made them last year. But by and large, we had belief in what we were owning, we stuck it out, and that's what is
and this also goes to probably buttress the belief that stay invested for the longer term, right? Just when you think it's the bleakest.
Because I don't think that we can hold fund managers accountable for every 3 months, 6 months, 9 months. Anyway, even when there is one bad year of underperformance, you can bring it down to actually which quarter, which month, and which couple of decisions might have. Like last year, for example, auto exposure and oil marketing company exposure was the big impact. So when you're in the thick of the problems, you need to think whether this is a passing storm or you want to really change few things.
Okay, so we have a query that's come in from Twitter. ANH wants to know, why did you change from your principle of buy right, sit tight and move to index investing?
So there's no change of principle out there. In fact, index is basically the market average. So, buy right, sit tight is basically our belief that, wealth is created by owning good companies, growing companies, and holding them over a number of years. That's why I mentioned in your previous question that our churn is very low and our average holding periods are 4-5 years. Now, coming to the index, that's actually it's a different vertical in my company. It's a different business in my view, and it is more targeted from a perspective that, in India, by the day, by the month, there are thousands and hundreds of thousands and millions of new customers coming in, and we are living in a world which is digital and DIY. So why did I restart or relaunch our index or passives business? In one sentence, it can be said that if you don't know what to buy, you buy the market.
Okay.
That's the logic.
So there's a class of investor that probably...
Yeah, it's segmented for a different set of people.
Okay. TK Indian wants to know, how did you end up avoiding sick NBFC stocks in your portfolio? And to be fair, they weren't, really sick when the investment was probably made.
So last year, actually, I'll tell you tell you upfront that last year we got a lot of attention for owning one small cap stock, which is Manpasand Beverages. And just like the exception proves the rule, that stock got a lot of attention because it was about 1%. Sometimes when you own small caps, the probabilities are stacked, loaded up against you, and every once in a while you can go wrong. But I think that got a lot of attention, and what the gentleman is asking here actually didn't get any attention.
Yeah.
Because last year, forget small caps, last year was a year where one could have made a zillion blunders owning frontline large cap index.
Yeah, basically every Monday was a fresh blunder.
Yeah, absolutely. So I think last year in that sense was very good for us because we stayed out of literally all of those. And my sense is that once in a while you go wrong, but otherwise if you stick to your principles, like you have certain thought process of identifying what a quality business or a quality management is. More importantly, all these companies had fast growth. So they would have actually fit into our parameters, but somewhere they might have been removed on the quality parameter or the quality of growth itself. Because a lot of times when companies are growing very, very fast, and plus we have the benefit of owning an NBFC ourselves. I mean, we should not forget that in 2017 our NBFC was the first one to kind of raise the red flag and say that, okay, look, there are certain issues and we are not going to grow.
Okay.
So we could read what was coming in some sense.
Okay, that makes sense. So what would an AMC like yours prefer, say, going forward from here? Discovered stocks which are expensive or undiscovered stocks which are cheap?
No, see, look, we became a mutual fund manager in 2013-14. Open-ended funds came there, but back originally 2003 onwards, we've always been a PMS, portfolio management provider, and a lot of our reputation has been that of a stock picker, getting into ideas early. So definitely, what drives us is being a mid-cap stock picker. I think that is what has earned our spurs, and that's what drives us. For example, last 1.5 years, one of the reasons for the turnaround is also because we are amongst the early guys in insurance. I mean, most of our portfolios are 10 to 15% insurance. So being early in a sector, being early in a stock, and not being in a hurry to book profits, like hold for 4-5 years. I think that is what drives us.
Okay. I was going through your Twitter feed and I saw that you've written quite a bit about introspection. So what do you introspect about, and what's the last thought or idea that you have implemented in your business? Yeah,
so I think that if you ask me why I wrote about introspection is, because I meet a lot of investors, I meet a lot of portfolio managers, I meet a lot of people in the industry, and my sense is that we may have various thoughts, we may be conducting ourselves in different places, but I think that if you are not able to reflect upon the events, the scenarios or the situations, and if you are not able to internalize the learnings from those reflections, then I don't think that any amount of knowledge imparted to you by the environment or any amount of studying anything, I don't think that is going to help. So, every cycle you go through, there are certain learnings. Unless and until you don't internalize, you don't reflect on it, I don't think that you can move forward.
Absolutely, absolutely. I couldn't agree with you more, but we'll take a very quick break. Aashish stays on with us. We'll come back. I have a lot more questions for him and a very interesting rapid fire round. Stay tuned. Welcome back. You're watching Fund Anatomy, and with me I have Aashish Somaiyaa, the MD and CEO of Motilal Oswal AMC. So Aashish, we've spoken a fair bit about the style that the house employs, but you've been a PM. You've done PMS. There's now focused funds, which are the theme. Don't you think that a focused fund should mean the death for PMS? There's a lot more transparency. Wouldn't it have a lot more going for it than a PMS would?
Actually,
except for the commission. So tell me now.
No, I'll tell you two things. So since you mentioned about expenses and commission right up there, I think PMSs do have a bit more liberty how to price it. But I can tell you an interesting thing which gets completely overlooked. We have about 15 to 16,000 crores on PMS. The only thing about PMS is that if you sign up, it's my agreement with you, so we agree on the charges. So if I take an average of our 15 to 16,000 crore assets, the weighted average charge on the PMS is actually lower than a regular plan of a mutual fund. This is unknown or a lesser known fact, because what happens is in a PMS a large client will pay you less and a client giving 25 lakhs will pay you the standard fee. But in reality there is a gradient which is pretty steep. Now coming to your question about focused funds and PMS, I think that mutual funds and PMS should not be compared because the vehicles are completely different, and I'll tell you just two reasons for this. First is that in a PMS, your portfolio is held in your demat account. So your portfolio of stocks and your fund flows, and hence your behavior and reaction to market events is isolated from the rest.
Okay.
In a mutual fund, you are part of a pool. And whatever we can discuss, but a mutual fund, what happens is when the performance is great, the market is booming, they get money. See, I can come to a studio and say whatever I like. But when people give me money, I am a buyer. When people take the money out, I am a seller. And you know what happens at what time in the market. December 2017, we had 45,000 crore gross flow. Today, we have 20,000 crore gross flow. So in a mutual fund, long story short, in a mutual fund, you are exposed to the sum total behavior of millions. And you are exposed to the vagaries of the decisions that the fund manager takes because of inflows and outflows. Whereas in a PMS, your flow and
the lowest common denominator.
Yeah, and see, look, if I get money, what do I buy? So everybody's portfolio changes. If there are 10 guys putting a redemption, what will I sell? So for no action on part of the remaining investors, everybody's portfolio changes with every inflow and outflow. Maybe I'm exaggerating, but there are times when flows are really big. Right, and people do come in at the top and they sell at the bottom. Now all of these things impact how a mutual fund works and how it has to be managed. But in a PMS, let us say you are a smart cookie. October 2018, you decided to double your investment, and October 2018, I decided to panic. So the price at which you bought, at that price, certain stocks were sold from my account and money was paid to me. Now you are 20% richer than me, and I exited at the wrong time. In a mutual fund, all these decisions and intermingling impacts the whole pool. In a PMS, it's isolated. Second thing is, obviously in a PMS, now mutual funds have got straitjacketed and commoditized because of the universe. Whereas in a PMS, we impose certain restrictions on ourselves. But just because a mid-cap stock appreciates, look, well, we buy mid-cap so that they'll become large cap. But nobody tells us that it's crossed 10%, so you have to sell. It's changed the universe, so you have to sell. I can give just one example. This is not a recommendation. This has actually happened in our portfolio. 2012, we bought ING Bank. Those clients own Kotak Bank today. I don't think it happens in a mutual fund.
Yeah, well, that's a good argument. Actually, I have to also go back and think about it, and I'm going to come back to you for sure. But tell me, if between a mutual fund, a PMS, or an AIF, what should be the preference for an investor?
I think people who invest in a PMS or AIF, they definitely need a higher risk profile. Because in a mutual fund, look, I explained you the differences.
They're just different categories.
Yeah, there are different categories. They need a higher risk profile.
Okay, now let's start the rapid fire round so you don't have time to think. If you were to devise an investor's portfolio based solely on the offerings by Motilal Oswal AMC, what percent or what amount of investment would go into which scheme?
If it's a person who is risk averse, it would be dynamic equity fund, and if it is a person who is willing to take risk, it would straight away be, in this scenario, it would be the mid cap fund.
Okay, a query has come in from Sanjay Dikshit. He wants to know, it's a request. He says, please include the S&P 500 base index fund, and most importantly, bring the MSCI World Index Base Fund to India. So you've been an innovator of sorts also in the past as a fund house. What is your next innovation? Could it be one of these?
No, I cannot. I can't say but it's giving me a very good idea. So I should thank him for that because we did the Nasdaq 100 about 7 or 8 years back, and I think what he says makes logical sense. So maybe I should work on it. Okay,
so Sanjay, think about asking for a commission. Active or passive, which is the way of the future?
It's for different segments of investors, but I think that people who are coming in new and who don't know what to buy, they should buy at least Nifty 500. That's the easiest thing to do.
Okay, most underappreciated risk by Indian investors?
Being underinvested.
Okay, that's fine. Saving versus investing versus wealth creation. Where do investors go wrong?
Wealth creation.
Why?
First of all, most people who think they are investing are actually saving.
Okay.
And most people who are investing are actually trading. And a lot of people who think they are trying to create wealth are, just being short-term investors. Because all the folklore in the market, what is the folklore of the market? You bought 10,000 rupees worth of Wipro in 1980, it would be 600 crore. If you bought Infosys in the IPO, this would happen. This is all the folklore.
Yeah.
Everybody sends it to each other on Facebook and WhatsApp. Nobody
But how many
practices.
are there? That's the naked truth. Okay, our fund managers' investing style versus the house or the AMC philosophy, which is more important?
No, we don't hire people who don't buy our philosophy.
Okay.
It has to be synchronized.
Okay, so in that case, what's the one question that you ask your fund manager when you're hiring them?
No, we actually see where they have invested in the past and what is their portfolio, and then we discuss with them that why did you own this, and what are your thoughts about this? Because look, there's no point in forcing somebody to align.
Yeah.
At least there should be some commonality of thoughts, and then one can think of aligning. But if somebody says that I am a contra investor, or I am a cyclical investor, or I believe in deep value, that means maybe he doesn't believe in high quality, high growth. So we can't work together.
Okay, if you could change one business decision which you've taken in the last 1 year, what would it be?
We run a small cap PMS, and I think I was late in closing it. We closed one say we have a next $1 trillion PMS, 2017 whole year it was closed. And there is another small cap PMS called India Opportunity. We stopped taking money in January of 18. I think I was late. I should have stopped it 6 months earlier.
Okay, that's honest. What's the biggest challenge in your job?
Communicating to investors and imparting, look, in my 20 years I have seen 5 corrections. So a correction, like if the portfolio is 15-20% down, it doesn't do anything to me. I know it will come back. But how to pass the conviction to investors?
I know you call it a challenge, but Aashish, you're one of the more communicative ones. But what's the most important lesson that you've learned in your career?
That's a tough one, but I think that it's not related to investing. It's more related to being a manager or a leader. I think that you should always, and I've been a salesperson for a very, very long time. So I read long back that never sell something to someone which you would not sell to your grandmother.
Yeah. That's the hope that investors.
Yeah, so that's the I think like our company invests in our funds. I invest in our funds, and unless we don't do that, I don't think we can go and talk to clients.
Okay, we spoke and you spoke as well about people redeeming, before the fund has reached its full potential. What would you say to impatient investors who are investing in a patient fund manager's fund?
I would just say, so it's very difficult for someone to, see, I can say it theoretically, but for clients to understand what is happening and why it is happening, it's a bit difficult. Because sometimes people think that we are just sitting around doing nothing, whereas we know that it's a passing storm and it's better not to react. A lot of times if we are wrong, we still might think that this is not the time to act, and we will try to correct the situation maybe few weeks or few months later. So all this will get resolved if people buy into the thought process or the philosophy and not the return. And somehow, if we are able to ensure that people buy when the chips are down, like I would have been really happy if people had given us a lot of money in September 18 or October 18 when the chips were down.
So basically, don't miss the wood for the trees.
Yes.
And finally, what's the most important investing lesson that you wish to leave behind for your kids?
I think that you just stay put. Don't get carried away by short-term
so keep your conviction alive.
Yeah, sometimes on a lighter note, I tell people that if I talk a lot about investing, I think I should have asked my parents that if you didn't you have 10,000 bucks in 1980, what were you doing? So obviously I can't ask them, but if my next generation were to ask me, what answer will I give? So I might as well practice what I preach.
All right, Aashish Somaiyaa, thanks very much for joining in and for answering our 20 questions. Thanks
for
very
having
much.
me. Thank you.
All right, with that, we'll wrap up then on Fund Anatomy. Do stay tuned in. There's lots more coming up on CNBC TV 18.